And there's other people that would say, well, this time is different, Tavi. Well, maybe blue line is going to stay there because, don't you know that silver is not what it used to be in the past? I don't believe in those things. I bet on history, and if I'm wrong and this time is different, it is what it is. But I'm definitely not expressing. I'm expressing my view very strongly that the blue line is going to rise, and so, and I'm willing to take that bet with history on my side.
You're watching Capital. My name is Danny. It is June 4th, 2025, and my guest today is the partner of Crescat Capital, Tavi Costa, making his debut on the show. Tavi, thank you so much for coming on, my friend.
Thanks for having me. Looking forward to this.
Yeah, definitely. Tavi, you're very well known on Twitter /X, whatever you want to call it. I mean, you're really very well known within these circles. But for people who may be coming across your work for the first time, and because it is your maiden voyage onto this channel, kind of give us a brief overview of who Tavi Costa is. How did you get? What is kind of like your origin story to get to where you are today, and what do you do?
Born and raised in an emerging market, Brazil. Grew up here, then played tennis in my late teenager times, and was able to get a scholarship to play in university in the U.S. Was always fascinated by finance from the very beginning. My dad owned a small business that that I was involved with from the very beginning, and after a few struggles, you start realizing the meaning of money from a different lenses than a lot of folks tend to have, which is more to me in terms of stability and financially speaking. And so I've always been fascinated by capital allocation themes and macro ideas. Started to work with Crescat back close to now over almost 15 years now. And at that time, I was very much, have had a view on emerging markets, was very bearish on emerging markets overall, given also my views on commodities. And that sort of shifted from there to start looking at more globally, not just in emerging markets, but Chinese views. And I was one of the first people to write about the potential Lehman Brothers moment in China, and the risk of most of the property developers and the banks and all that. Then I moved into, back in 2018 or so, started to really dive into commodities, mostly because of gold, and mostly because I stumbled into a chart that I created at that time, which was the capital spending cycle of commodities. And that sort of opened my eyes to, you never know what's the real trigger for a commodity bull market, but the foundation of the thesis was there. I had no idea gold was going to bottom exactly at that time, but gold started to bottom back, I think it was in mid 2019. And we launched a precious metals mining strategy at that time to invest in those companies. And during the COVID crash, I also had no idea we would see the degree of the fiscal spending and monetary policy that we saw during that time. That changed my view in beginning of 2021, wrote a big paper talking about inflation, very beginning. In fact, I think it was in December 2020, wrote a big paper about inflation, got my name around because of that. And then 2021 came along, wrote about the Treasury market as well, about how the issuances are going to have issues and cause rates to rise at that time. And now back, maybe you can read my stuff in September or so, I started to really develop this view about the dollar. And my view now, probably for the next 5 to 10 years, is that we enter a very pronounced dollar cycle that will likely drive a lot of other assets. And that's really where everything started to where I am right now. Very focused on mining, very focused on resources, and trying to be more and more focused in emerging markets. In fact, I'm in Brazil right now as well. So
very fascinating. Since you mentioned your analysis on the dollar, I see you've got this pinned tweet here. This looks at the history of the dollar. It's a 10-year rolling change in the DXY. So explain to the audience, what is the significance of this chart?
This chart is stepping back from a 10-year horizon and looking at the 10-year rolling change of the DXY index. And there's all sorts of ways, in fact, this letter that I wrote had other ways of explaining, at least the way I see it, the dollar changes over time. And the dollar in any asset will be very difficult to see when you're looking at daily charts. But when you're stepping back and looking at big 10-year trends, you can kind of, really see big cycles that tend to occur. And the dollar is no different, and probably the most important one, in fact. When the dollar is doing well, the whole milkshake theory has been spot on. And certainly that is the case. It sucks all the money from outside of the world. And what you see is a bid on U.S. equities, is a bid on U.S. assets, or dollar-based assets. And every one of these upward trajectories of the dollar, you had different types of asset classes benefiting from those inflows. And back in the tech bubble, obviously, was technology. I'm calling the tech bubble number 2 today, but Plaza Accord had nothing to do with technology. It was more to do with the Treasury market actually receiving a lot of those flows. And then when you turn the dollar, for many reasons, usually because the dollar is too overvalued, or because you have an administration right now focused on trade and fiscal balance, of which by definition you have to devalue the dollar. So you have all these sort of factors lining up that usually tend to cause the dollar to depreciate. And that's when you have, the other side of that, leadership in markets. You have, back in the 80s, after the Plaza Accord, we saw Japan doing very well. Japan actually grew to become one of the largest bubbles in history on the back of that. And then you've had in the early 2000s, you saw China doing extremely well during that period. Was really the economy that was driving global markets overall. And not only that, you saw commodities doing quite well. Emerging markets did very well. The Brazilian market alone was up 18x during the early stages of 2000s all the way to 2011 or so. And so in my view today, we're seeing just the beginning of that. The dollar is starting to weaken substantially. And I believe that that's just marking the very beginning of that. It's not a coincidence, the fact that markets are so overvalued in the US versus other places in the world. It's also not a coincidence, the fact that when you look at the trade-weighted index by the Federal Reserve that looks at the dollar, is also showing that the US dollar is one of the most overvalued levels we've seen in history. And so something has got to give here. And I believe we're in the process of seeing that. And as we see that unwinding, there's going to be a lot of things that are likely to be triggered. It could be a commodities bull market. It could be a gold bull market. It could be a resource stocks bull market. It could be an energy bull market. It can even be an emerging markets or other developed economies bull market, or it can be all the above. And so I am of the view that, certainly there are a few things that have been neglected for a long time that could come back. Latin American stocks is certainly one of them, but there are plenty others. And why, I think mining is also going to be a huge aspect of all this as well. So it's an exciting time to be, an investor. And I'm using those lenses. Nobody has a crystal ball here, but if I had a crystal ball that I knew that the dollar would be down substantially 5 to 10 years from now relative to other currencies, how would you invest in that world? And that's kind of the way I'm trying to operate at this point.
Right. I'm looking at these prior tops here, the tech bubble and the Plaza Accord. I know that within, from 2000 at the top of the tech bubble down to where you've got U.S. equities undervalued here around 2011, this was predominantly your last big commodities bull market. Gold also hit all-time highs here towards the end. Did the same thing happen during 85? I mean, maybe I should know this, but did we see a run in gold between 85 and 90? What is that, 94, 95 as well?
No, it wasn't. No, in fact, gold was in a bear market for basically the 80s, 81 all the way to 98, 99. In fact, it was down a lot during that period. People, that was a time when you saw these magazine covers saying that, you know, gold was a pet rock and all these famous headlines at that period. And that's when the metal turned after that. So no, and in fact, I think the biggest thing that drove gold markets not to rally at that time was the fact that central banks were actually buying treasuries in a big way. Treasuries are so undervalued at that time. Imagine getting paid double digits in US treasuries and with inflation at its peak. And so a lot of central banks actually, in a very globalized environment, you've had a lot of institutions willing to purchase US assets in a big way, especially treasuries, that basically drove one of the largest bull markets in treasuries we've seen in history. But also, gold suffered at those earlier stages of that bull market. But yeah, this is why, each of these cycles can be different. It doesn't necessarily mean we're going to see emerging markets doing well or Japanese stocks doing well. I happen to believe that, I have higher conviction in some parts of these asset classes and ideas that tend to work in a downward movement for the dollar. For instance, I'll give you an example. If you look within emerging markets, you have about, everyone talks about the rebalancing out of the US into other countries. But what about the rebalancing within the emerging markets index, right? 70+% of the index of MSCI emerging markets is actually from Asia. And so, as the world sort of shifts away from these manufacturing countries in Asia into other parts of the Western societies, I suspect that Latin America can be a much larger percentage of the emerging markets index alone. So I would be overweight that versus Asia if it was me. And so, but that's my bias towards how the cycle would work out. But there are plenty of ways, like for instance, you saw the dollar yen carry trade idea that developed over, 20, 30 years. Maybe we're on the verge of seeing something similar in emerging markets where you can basically borrow money in US rates to then return something in emerging markets yields. I mean, you have yields in emerging markets, some places well over double digits. And here in the US, you have all this pressure from the fiscal side, that could potentially cause rates to fall substantially, especially in the short end, allowing you to then borrow money in US dollar terms and then invest in other places outside. That was the beginning. I know it sounds crazy, but that was the beginning of the yen dollar carry trade, thesis, and it was exactly something related to that. So I believe, of course, in a separate way, right? You borrow in yen to then buy in US. So
right.
I think that's going to be the case here.
So a couple things stick out here from looking at this chart. Number one is that the last two or three tops, actually, you're seeing lower highs, right? Plaza Accord was all the way up here. You had a dollar spike at the 70% level. Then you go down to the tech bubble, although to a lesser degree, you have the tech bubble 2.0. It appears to be at almost the same level, but slightly smaller. And then you also see these, if you compare the upswing in the dollar from from its bottoms to its tops, if you look at the first wave here, you've got 1981 or 1980 all the way out until 1985. That's 5 years. And it takes from 1985 to, maybe around 1995, right? It's 5 years up, 10 years down. 5 years up here again from 1995 to 2000, and then 10 years or 11 years down from 2000 to 2011. If you're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you. Now, this kind of changes with the recent wave that we're in. 2011 went up. We had an upside move all the way out until 2022, I'm presuming. That's what the circle is, or 2021.
Yeah.
So 11 years, and then so you've effectively doubled your upside swing time duration versus the other two waves. Is that indicative of something? Coupled with the fact that you're kind of seeing these higher lows, is this kind of like illustrating the weakness of the dollar being able to get back up each time?
I think in a certain way, yes. And also you had a world that simply cannot sustain a much stronger dollar, right? And I also think that government debt at those prior peaks that you're looking at in the screen were nowhere close to where we are now. And so arguably, that's one of the reasons why the dollar is sort of capped on how much it can run on the upside. And I really think we're going to see the opposite of the dollar milkshake theory. And I really do. I think that's that theory. I've subscribed to that view, by the way, and even Brent Johnson himself. We had many discussions about this, especially regarding China. If you go back to some of my stuff on China, you will see it. I was quoted on Bloomberg, very strong views on China is going to the value and all sorts of opinions on the economy. And China was similar in that sense. Like you didn't know what asset was going to perform, meaning you knew that there was a bubble, you knew that there was a credit issue, and all these people at that time, it was funny because it was a time when it was very unpopular to say China was a bubble. Everyone thought China was going to take over. And I remember very well writing a paper that was extremely unpopular saying, I think China's closer to implosion than actually doing well. So just to give you some sense, but I didn't know what asset would perform, meaning I didn't know if the way to express that view was equity shorts or bond shorts or that the currency was going to devalue. And you never know these answers, right? I mean, you kind of can see the thesis, but it's really difficult to pick which asset class will perform well. So we position ourselves in all these arrows, essentially. And ultimately, the equity side was one of the biggest ways to perform in terms of that. The currency did some movements as well. I'm telling you this because it's kind of the same way I see this trend today. You can see that the dollar cycle is turning. The big question now becomes, where do you invest? And so you have to be very open-minded to all these other ideas that tend to work in this environment. Which ones are those? It could be energy. It could be agricultural. It could be mining. It could be Europe. It could be Canada. It could be Japan. It could be Brazil. I mean, seriously, it could be South Africa. Nobody knows. It could be India, nuclear. So, I think a portfolio needs to be very well constructed in all these arrows. And it's not massive. I mean, all these arrows, it's very easy, not easy, but nothing is easy in this market. But it's somewhat there's a lot of evidence that we're probably going to be seeing capital flowing out of tech into those areas. And so I'm trying to operate under that assumption, and that's how investors do, right? And you have an assumption of the market, you express that view, and you see that how that develops, and you can shape that view as you go, as you see more evidence of that thesis working out. The China thesis, there was a lot of signs when you start seeing the banks and the property developers one by one starting to fall. You kind of, you had to shift your point about, all right, maybe equities are going to be the way where the PBOC is going to allow this trend that is inevitable to unfold, because there's policy making, underneath this whole thesis as well. Like, what will policymakers do when they start seeing these macro changes in the environment? The same is going to happen with the dollar as well. And by no means I think the dollar is going to lose its reserve status. I'm not of that view at all. I just think that we're in a downward cycle for the dollar. This is not a end of the world call at all. It's just a normal cycle in macro, and that's all.
So I want to pull up the gold and silver chart because gold and silver are very intuitive alternatives to the dollar. But like you illustrated in your previous chart, that it's not always the case that capital rotates from the dollar to gold or silver, like we saw in the 85 to what was it, the 1980s down to the mid 1990s, where you saw capital rotate not out of stocks into gold, but out of stocks and into bonds.
Yeah.
But nonetheless, you do have this really nice chart here. I want you to kind of comment on this. It appears you've got silver denoted in blue and you've got gold denoted in yellow. And as we can tell from a historical lens, the chart goes back up all the way to 1975. Mm-hmm. The two tend to rise in tandem, although when gold rises, silver has a much more explosive move to counteract that. You see gold moving, having its big spike in 1980 up to just a little under $1,000. What was it, $700, $800? But silver spikes way above that from relative to its starting point, right? It's a 3x move relative to gold from that starting point. 2011, it looks like it's about a 2x move, right? Gold spikes up to near 2000 levels. Silver spikes up to 50. Which on a relative basis is an outperformance. Now today we've got silver underperforming gold.
Yeah.
Explain to us the likelihood that we see another explosive outperformance on the part of silver, and where do you think the precious metals as a whole go from here?
Well, I think it's always, my view of markets is usually you kind of have this, what's the easiest asset when you start seeing these big shifts in the macro. Some of the easy assets to attract capital will be the first ones to benefit from those changes. In case gold is the easiest one to understand the case, right? I mean, it's got centuries of history, has played monetary role like no other metal. It's been always held by central banks. So to your point about, we had prior times when the dollar turned, why not this time gold won't work and the dollar turns, just like prior times that we've saw this in the past. And you're not wrong, but you have to understand as well, perhaps in my view, that there's sort of a long list of reasons why gold is entering a long-term bull cycle, in my view. And some of them are what's happening with central banks. Central banks back during that time that you referred to when gold did not work and the dollar turned, central banks were loaded with gold at that time in their balance sheets. They held close to 75% of their balance sheet in gold at that time. Do you know how much it is today? Less than 20%. So it's a drastic difference of capital allocation. Then look at family offices or just pension funds and all these large institutions. They barely own gold. In fact, they barely own silver, copper, commodities, miners, resource stocks. Why? Because they haven't worked. And so outside of gold. And so, as things start to change and the easy asset attracts the capital, people start saying, all right, well, what's the next gold now? And the next obvious gold, in my view, is silver. It has been performing well. It's not like people tend to, and this is the case, by the way, with most ideas that I like, and I start growing conviction, is when you present an idea and people get back to you and say, well, you could have said this 20 years ago and nothing would have happened. I wasn't saying this 20 years ago. I've been saying this for a year, maybe 5 years ago, 4 years ago. And gold has been moving like never before. And silver, it's not like it hasn't performed well. It has performing okay, just hasn't performed as well as gold. The miners, for instance, have outperformed S&P 500 over the last 10 years, dividend included. And it's remarkable to see the skepticism over this industry, despite the fact that performance is already outpacing the market itself. And so And so you have to kind of look at this with the lenses as well of the depressed capital in the mining industry. Production, where is production of gold? Where's production of silver? Are we going to see new mines come online and change the supply curve? No. And we also know that most of the capital that the miners are making, what are they doing with that capital? They're paying back dividends and buybacks and returning the capital back to shareholders. They're paying down debt. And so, nothing is changing the supply curve whatsoever for the next 5 to 10 years, given the timing it takes for an investment to actually translate into new supply. So all these things are big macro changes that are likely to be adding to the fuel to this secular bull market in metals. And then another point to point out as well is the deglobalized environment that we have entered. It just happens to be the case, not a coincidence, is what I'm trying to say, that you enter a deglobalized environment as you have excess of debt in globally as well, and that's just normal. When you have too much debt, you start seeing a diminishment of growth, and as you see that, it's harder to be a politician, and then politicians begin to become more populist, and that's when you start seeing changes in the whole deglobalization environment. And so I am a firm believer that's just, sort of, we've seen maybe the early stages of this, but there are long legs is still occurring here in the next 5 to 10 years in a deglobalized environment. And so all these things sort of point to metals. And there's another point that I didn't even mention here that I think is probably the most important one, is the potential for a black swan event in things like shortage of electricity. No one is talking about how much we're going to use of electricity because of AI, and the grid problem. The grid is not ready for that, and the onshoring, and all these things are going to create a huge demand for metals, in my view. And I think silver is going to participate that in a big way. And so, there's two ways you can look at this chart: the gold and silver. You can say, "Wow, what an opportunity!" That's the way I see it. And there's other people that would say, well, this time is different, Tavi. Well, maybe the blue line is going to stay there because, don't you know that silver is not what it used to be in the past? I don't believe in those things. I bet on history. And if I'm wrong and this time is different, it is what it is. But I'm definitely not expressing, I'm expressing my view very strongly that the blue line is going to rise. And so, and I'm willing to take that bet with history on my side.
Yeah, especially considering silver's industrial usage on top of it, which is pivotal to the grid amplification. Since you mentioned the central banks being, allocating more now than in the last several decades, I want you to look at, you posted this chart as well. Most buying by central banks is undeclared. This is looking at estimated purchases in blue and declared purchases in yellow. Now, declared is what they've actually announced, I'm presuming. And so the delta between the yellow and the blue is the blue is what they actually bought. The yellow is what they reportedly bought. Is that correct?
Yeah.
Gotcha. So it looks like we're seeing the last 2024, 2023, and 2022, a lot more buying from central banks than we're being told. What are the ramifications of something like this?
Well, I think it's very difficult to know, even if these estimates are correct. The reason why I shared this chart, it wasn't done by me, it was done by Bloomberg, is because I've been trying to figure out myself that same question. And my number is actually higher on the blue line, to be honest. But I suspect, and this is, it's going to come maybe a little bit, in a way, a little bit against the crypto people, but don't take it that way necessarily. But I want you to think more, I guess, logically and rationally about this situation. When you're a large institution and like a central bank, of which there's so much capital, and you move the market so quickly that you have to truly consider how you approach accumulating an asset, right? And so when you have the Treasury, for instance, Donald Trump coming out and saying, we're going to be accumulating crypto assets, right? When you announce such a thing, what do you think crypto assets are going to do? They're going to rise, right? I mean, on the back of those news. Why you, as a buyer, who is, of course, if you're a buyer, you're looking to acquire those assets as cheap as you can. Why would you do that? Why would you announce something and then go and buy it? Why would you not just buy it and then announce it? Right? I mean, we've seen this throughout history many times where central banks and the Treasury can do that, without announcing anything, and then later on just say, well, look, by the way, we accumulated, all this, of these ounces of gold or Bitcoin, whatever that is. How can I take it serious when somebody comes out and announces that they're going to be buying a certain asset like crypto and completely ignores gold, right? Completely ignores gold. And then I see gold surging, and everyone is still focused on the crypto. And it's so clear.
It's a red herring almost. It seems like it's a red herring.
Yeah. It's like, okay, great. Some people are making money and good for you. Are we all just missing the elephant in the room here? That gold is rising. Clearly, the volume being reported is not in line with the move we're seeing. I mean, gold just took on $1,000 an ounce. I mean, this metal doesn't move like that. We all know this historically. Gold is having its best, performance since the 70s. And we're not talking about an asset that is $1 trillion going to 2. We're talking about an asset that is, used to be 12 or so $1 trillion, and it's now over 20. I mean, it's a huge market. And so I just find that fascinating. And so when I see a chart like this, I believe it wouldn't shock me at all if the blue bars, of which everyone thinks it's China, and it probably is, a lot of it's probably China, but everyone is just completely underestimating that the Western societies are probably participating on this as well. I don't think the U.S. Treasury is that dumb. I really don't. I don't think Scott Bessent is stupid. I really don't. I mean, his largest position in his hedge fund was what? Was gold before he as a Treasury Secretary. So it wouldn't shock me at all if the U.S. Treasury is participating on this. And I think it would make a lot of sense if the accumulation process is happening in the Western societies now as well by large institutions.
Right. And if these blue bars are indeed correct estimates, then it tells us that something weird happened in 2022 to just elicit this panic, because it does seem like a huge panic. And when you ask yourself what did happen in 2022, a couple of things stick out. You did see the beginning of quantitative tightening, Fed rate hikes, and then you also saw the start of the Ukraine war, BRICS becoming more prominent. They had been fairly dormant before then, but it's really that since 2022 that they've become a more prominent part of the limelight. So why do you think 2022? What happened in 2022? Because it's also interesting, I don't have it ready, but if you chart the 10-year yield, it has a declining pattern from 1980 all the way out until 2022 until it breaks through. So the 10-year yield broke through its bear market during that time as well. So it seems like 2022 is really when things began to kick off. What do you anticipate is the cause?
I suspect was when the U.S. decided to seize those Russian assets, and I think that was a fundamental shift on how people perceive U.S. assets in their balance sheets. And I also suspect that that's exactly why you saw real interest rates. If you recall, there was all these charts. I published that many times as well, and other folks did too, about real rates diverging from gold. You could see an explanation of gold was always been on the back of real rates. Real rates fall, gold rises. And then all of a sudden we saw the separation of that and that of the whole connection between those two asset classes. And the main reason for it is because people were selling treasuries, causing yields to rise, and then buying gold. And I've always been of the view you want to go back in regimes that are similar to now and see how assets perform during those times, and see there's differences and differences in behavior. And I find it fascinating, for instance, when you look at, for instance, the dollar, in the 70s. Was the dollar, everyone talks with so much conviction that the dollar should be your safe haven today, right? If the market falls, everybody buys the dollar, don't you know
Right.
this? Yeah. Well, the 70s wasn't like that at all. In fact, Nixon came in trying to fix a trade balance problem, just like today, like Donald Trump is trying to do, a balance of payments problem, as he mentioned. And how did he fix that? By causing the Japanese yen to rally massively versus the US dollar. That changed the behavior of asset classes at that time. And when markets fell, the dollar actually fell along with the markets. And so people are still underestimating those things. I mean, they're now getting that the Treasury market could fall with the markets. They're still not understanding that maybe the dollar can also fall with the markets. And so I'm not trying to say I'm the smart guy here and I know the answers for these things, but all I'm trying to say is be very open-minded to that regime. By no means, this is the 1970s. We have a lot more debt. The world is much more deglobalized than it was back then. I would argue or at least the trends are going that direction. And so I just think that there are some similarities of behavior in markets that we're starting to see, and I think they're going to go on for the next 5 to 10 years, most likely, because once those flows change, the way institutions behave in times of turmoil is also shifted in a big way. So you have to kind of respect those changes in behavior and think that is just the beginning, not the end of it.
Yeah. So I pulled up the 10-year yield that we talked about, and you can see it's been in a declining market since the 1980s. And in 2022, just around April, March, somewhere around then, it broke out of this resistance line, and it's been moving on higher. So
Yeah.
Again, 2022 seems to be the magic year when things began to unwind. They screwed something up in the markets or in the geopolitical realm by freezing those Russian assets, let's
Yeah.
say. But yeah, very interesting stuff.
Yeah, and by the way, I think there's been a lot after the fact, after 2 to 3 years now of pressure in treasuries, people are now coming to the view with all this heavy, strong conclusion. This is the end of the treasury market, blah, blah, blah. I'm not in that camp. That was your view that you're supposed to have 3 years ago, not now. And I think we're in a position where it's becoming almost critical for the U.S. to suppress rates. And I don't know if it happens through yield curve control, if it happens organically through recession, if it happens through just buybacks from the Treasury. I think that's the next move in my view. I think 2-year yields can be cut in half from where it is now in the next 12 months. And I think there's a lot of pressure that is going to be coming out in the next 12 months from policymakers to do everything they can to lower rates. And through agreements with other countries, Mar-a-Lago Accord, nobody knows the answer for what it's going to be.
Right.
But, I'm focused on the yields falling in a big way. To me, that's another thing that is in line with the dollar change. And sometimes I say these things and people, well, Tavi keeps saying these things that he doesn't know. In markets, you don't have to have the answers for everything. You need to have an answer for your asset class that you're focused on and the movement you think it's going to have. That I have a view on. I think yields will fall, particularly in the 2-year, and I think the dollar will fall alongside with it. And so, and mostly as a response of interest rate differentials between U.S. and other countries that I think will change and drive that movement in a big way, because the U.S. has a much greater urgency to lower rates than Canada, than Japan, believe it or not. And so how much Japan is paying on interest payments to GDP? Does anybody know that? Less than 1%. Do you know how much the U.S. is paying? Close to 5%. So, who needs to lower rates tomorrow? Not Japan. I'll tell you what, it's the U.S. And so that's an unpopular view. I know it's unpopular because everybody thinks the Japanese is blowing up right now, the JGBs and the 30-year yields in Japan. Doesn't matter. Most of the debt in Japan is in the 5 years, not the 30s. And the reason probably why that's happening is because they're probably having an agreement in allowing the 30-year yields to rise in Japan, to move and give more support for people to buy the yen versus the dollar, and then fix the trade balance. I think that's a much more plausible explanation to what's happening than coming out like Zero Hedge and saying this is the end of the world. Japanese bonds are blowing up. I think it's on purpose. I don't think this is that they're losing control. They already own over 50% of their bonds anyways. So
I see. Well, fantastic discussion, Tavi. Anything else you want to talk about before you wrap up here?
I'm happy to go anywhere here, but I think the last thing we didn't talk that I would just point out as an idea, as the audience perhaps is looking to find a way to sort of think about the world and invest. One thing I suggest people to ponder on is what are the two factors that usually cause you to not invest in emerging markets. And those two factors tend to be rise in yields because it becomes competitive. So if you have 10-year yields in the US rising, for instance, why would you take the risk of investing in Brazilian 10-year yield if you can get almost as good as of rates here in US dollars versus that? Or the second thing is instability of the currency. If you have the dollar rising substantially, so let's say you catch the beginning of a dollar movement to the upside, you're going to get crushed in emerging markets. And so I believe you sort of have a world where the dollar will be capped and yields are likely to be capped. And that's a green light in my book for emerging markets. So, I'm extremely focused on that because I think emerging markets have been, some emerging markets have been neglected for a long time. And as you see that flow turning, it's going to be very explosive for some countries, what they can see in terms of potential returns. And so I'm extremely excited about that market specifically.
Awesome. Well, hey, Tavi, where can people find you if they want to hear and see more of your work?
They can find me on X at Tavi Costa, or LinkedIn, Tavi Costa, or also on the website of Crescat Capital, Crescat.net is where we write our letters and all sorts of things. So you can find in-depth research. I recently wrote a letter about this electricity shortage issue that I think is fundamental for people to understand. So it was a very in-depth research that I worked on over the last few weeks. And so if you want to learn more, I would suggest you to read that as well.
Awesome. We'll have the links to all of your socials down below. So check them out, guys. If you're interested, if you got value out of this content, drop us a like and comment, go Tavi, go in the comment section. If you disagreed with anything, that's fine too. Let me know what you disagreed on, though. I do, in fact, read the comments. And don't forget to subscribe to the channel and share the video for those who you think might be interested. Every little bit helps in getting this video and this channel boosted in the algorithm. And then check us out on Substack as well. Become a member and get free access to, not free, but if you become a paid member, then you get access to all of my stuff early, ad-free, and uncensored for the videos that warrant it. So with all that said, thank you guys for watching, and I will catch you next time.